In this lecture, we'll talk about economic value added, or EVA as it's commonly referred to. Economic value added is a simple but very effective and powerful technique that makes visible the hidden cost of equity capital. When we're talking about costs, let's start out with a clear distinction between fixed and variable costs. Take the following simple example of a candy making operation. This candy making operation has a plant with a value of $10 million and a cost of capital annually of 10%, which means that the fixed cost of operating the plant works out to be $1 million every year, regardless of the level of output. We'll consider two types of variable costs that change or vary with the level of output: the number of employees and the amount of chocolate, wrappers, and other inputs necessary and required for making the chocolate candy bars. Let's make a very simple assumption. Each individual employee costs $50,000 and can produce up to 100 bars. Each candy bar requires 50 cents in materials in order to be produced. The fixed costs, we can see, do not vary with the level of output. Whether the company makes 0 candy bars, 1,000 candy bars, or 5,000 candy bars, the fixed costs are just that. They're fixed at $1 million. On the other hand, the variable costs, which include both the labor, the salaries or wages for the employees, as well as the input materials, we can see do go up or vary with the level of output. For 1,000 candy bars, such a production level will require 10 employees. Remember, each employee can produce 100 candy bars, so to produce 1,000 candy bars requires 10 employees. At $50,000 per employee, that cost equates to $500,000. A second variable cost is the cost of materials for each candy bar. At 50 cents a bar, the total cost for 1,000 candy bars works out to be $500, and so the variable cost of both the wages and the materials for production at a level of 1,000 candy bars is $500,500. You can see that goes up. In fact, it doubles when we double production from 1,000 to 2,000, doubles again from 2,000 to 4,000, and so on. The total cost is the sum of the fixed and the variable cost, as this graph illustrates. The fixed costs, representing the $1 million, are the flat horizontal blue line. The variable costs increase with output level, and the total cost is the sum of the two. Let's make this candy making example a little more concrete and realistic, and consider Cadbury operations in Bombay, India. Cadbury is one of the world's largest manufacturers of chocolate confections. In 1978, Cadbury realized that they were having a very difficult time attracting middle and upper level managers to relocate to Bombay and their Indian operations. And so they instituted a free housing program for their managers. Cadbury effectively purchased a large number of apartments and offered those apartments to their managers. Over time, management who stayed in Bombay expressed a desire to purchase their own housing, move out of the apartments, and so in 1991, Cadbury layered over a second benefit, namely company-sponsored low-interest rate loans offered to managers who used the funds to purchase housing off-site or purchase their own primary residence. Now, one of the things that happened when that low-interest loan program was instituted was that fewer and fewer managers opted to live in the apartments owned by the company, and more managers took advantage of the loans and used it to purchase residences. Nevertheless, Cadbury maintained ownership of all of those company-owned apartments, despite the fact that the vacancy rates were continuing to go up over time. One of the reasons that they maintained ownership was because nowhere was the cost of owning those apartments made explicit. That is until 1997, when the company adopted an economic value added, or EVA, approach. Economic value added makes explicit costs that would otherwise remain hidden. In this case, the cost of the apartments was calculated and explicitly charged against the various divisions operating in Bombay. As soon as the managers in those divisions realized or recognized those costs, they made a decision to sell all of the unused apartments and redeploy the capital or the proceeds from those sales into other, more productive uses. How did this increase profitability? The capital that was tied up in the apartments, the vacant apartments, was essentially or effectively earning a 0% rate of return. By selling off those assets and redeploying the capital to a higher valued use, Cadbury management was practicing the very simple art of business, identifying assets in low valued uses and finding a way to profitably move them into higher valued uses. In this case, they identified it only after that cost of holding the apartments was made explicit, and the act of selling them and redeploying the capital elsewhere constituted the movement of assets from low to high valued use. Another example of economic value added, very commonly used, is to make explicit the cost of equity capital. Let's look at this income statement for Cadbury. Many of the items you'll recognize here, and all of these numbers are in pounds, British pounds sterling. So for example, the net sales were about 6.738 billion British pounds. Cost of sales, 3 billion, 20 million, so $3.020 billion, for a gross profit of 3.718 billion British pounds. Now, as we focus on down this income statement, what I'd like to focus on are three numbers. Selling, general, and administrative expenses, a commonly found line item on the income statement. And it makes explicit right there on the income statement the expenses associated with those categories. In this case, we see it's 2.654 billion British pounds. A second type of expense that a company incurs if it has, say, issued bonds and raised capital in the debt markets is the net interest expense on its bonds. Bondholders purchase bonds from the company, and in return, the company agrees to pay those bondholders a fixed coupon or a fixed interest rate. In this case, the Cadbury income statement shows that the net interest expense was 226 million British pounds. That is the rate of return that the bondholders expect and that the company is obliged to provide. The bottom line, net income or net earnings, we can see as a positive 431 million British pounds, what would seem to be a fairly healthy and positive profit. However, there's one very important cost that is hidden or does not show up anywhere on this income statement or any income statement for that matter, and that is the cost of equity capital. Like bondholders, stockholders provide capital to the company. Like bondholders, stockholders expect a return on their capital. But unlike bondholders, whose interest expense is explicitly recognized on the income statement, nowhere does the income statement account for the cost of equity capital. That is, the portion of those profits that are expected by the shareholders simply as a return on their capital. Economic value added makes explicit this hidden cost of equity capital, and it does so in a very simple way. The economic profit, which captures this idea of economic value added, is simply equal to the accounting profit, or net income, minus the cost of equity capital. From the previous slide, recall that the accounting profit was 431 million British pounds. How do we calculate the dollar cost of equity capital? That requires two inputs. It requires us to know the amount of equity capital, which we could take simply from the balance sheet. In this case for Cadbury, it was right around 4 billion British pounds. The second piece of information we need to calculate the dollar cost of equity capital is an investor expected rate of return. Now, calculating that rate of return is a little bit beyond the scope of this discussion, but there are simple and straightforward finance techniques that are used to calculate the required return on equity. It's typically a function of the riskiness of the firm, the interest rate on the risk-free asset, and the expected return on a broad market portfolio. Let's suppose that that required rate of return for equity is 14%. The dollar cost of equity capital is calculated as the dollar amount of equity, $4 billion, times the percentage required rate of return, or 14%. In this case, that works out to be 560 million British pounds. What that means from an economic standpoint is that the equity holders who had supplied $4 billion of equity and were expecting a 14% rate of return implicitly expected 560 million British pounds in profit every year. The economic profit takes the actual net income, 431, minus the expected or required cost of equity capital, 560, and we find that in this case the economic profit is actually negative, a negative 121 million British pounds. How do we interpret this? The interpretation here is that if the economic profit is positive, the firm is adding economic value. In this case, the economic profit is negative, meaning the firm was actually destroying economic value. Yes, the net income was positive, but it was well below the level that shareholders would expect given the characteristics of the firm. Economic profit, therefore, makes explicit a hidden cost, and making decisions based on the economic profit rather than the accounting profit will, over the long run, lead to increases in firm value and better economic decisions. I want to thank you for listening to this lecture on economic value added and how EVA makes visible the hidden cost of equity capital.